What is going on, everyone? It's David Ramsden-Wood here with my man Mark Rossano, and we are here for the Primary Vision and Hot Take of the Day pregame show, where we walk through the key events of the last week that are going to set you up for the next month, and all the videos that are going to be released by Primary Vision going through the economy, China, EIA, Iran. And this week, let's get in right hot and heavy right off the bat. Mark, on Friday, the market had a conniption over a failed 7-year auction, and by Monday, all of that was forgot and it was back to the races. What was going on? Help me understand that.
So the 7-year auction came in on a bid to cover ratio on a near 12-year low. So anything above 2 is still deemed successful, but it was just barely over 2. So there's a lot of fear that, especially as the U.S. comes to market with all of that fiscal spending, they have to go out and borrow because receipts are just not going to cover it at this point. So the look is that there's going to be this increase in volume, and the Fed is really kind of hamstrung in terms of how much they can purchase just given inflation. So then you might say, well, everything was fine by Monday, and it was really driven by the Australian central bank coming out and doubling down on their yield curve control. So they bought double what they were supposed to in order to try to signal to the market that, look, things are okay. We're willing to do whatever it takes, as we always like to hear, to try to protect yield in general, to try to support the economy on a monetary level. Now, even though things got a little bit better on Monday, and they were definitely better than they were on Friday, we still have rates creeping higher, even in the U.S. And this is something that's going to be a continued fight back and forth in terms of just what are rates going to do as bond prices come under pressure.
So walk me through this, because again, we continue to have this bifurcation where there's so much liquidity in the market that revenue-less SPACs can come to the market and people can throw currency at it. A company like Nicolas, who last week came out with their earnings and they had virtually zero revenue. Now, when I say virtually, it's because apparently they had $90,000 in revenue from installing solar, which may or may not have been on their CEO's house, against $72,000 a cost, but they have a $6 billion market cap against $90,000 of revenue, and there's so much money in the system. Why is the Fed not unwinding the balance sheet? Why do we keep doing this? What are we doing?
So the view is that they're trying to make up for what fiscal limitations there are. So they're trying to maintain a certain amount of monetary stability by pumping some of this liquidity into the market and being supportive of banks. Now, the issue is the banks don't really need all that much support, for anyone who's been watching the bank stocks, because they physically don't have anywhere to put this capital. So even though the Fed is doing what it can, it's living between two streams. It's going back and forth between the banks and the Fed, and we're seeing that show up in the repo market, and that's the overnight market. For anyone who has a money market account at 2 p.m., yet that account is technically zero, and it goes into the overnight market. So banks have turned around to their institutional clients saying that you guys have to limit the amount that you're keeping in your money market and invest it in short-term paper, short-term elsewhere, because we can't handle that amount of flow, only because the overnight market is starting to go negative. So we're getting this weird conundrum that we're in, and this is where we start getting complicated into duration. And duration is just time, where the further out we go, the worse the curve looks. And that's why we look at the belly of the curve, or that shape, because we did see some support come in on Monday after some initial weakness, but the long dated, that 10, 20, 30 years still does not look pretty when we're considering what this is going to look like over the next few months.
Let's pivot to China, because we always want to talk about China in terms of where they're at. They finished their lunar calendar holiday. There was less travel. There seems to be demand. They're looking at maybe rare earth export limits. I saw a tweet over the weekend that said that 71% of the solar panel manufacturing by megawatt in the world is in China. And we're relying on this expansion of solar panels to backfill some of our energy grid. Where is China at, and what are we thinking is going to be the next major data point coming out of China that you're going to talk about on the Primary Vision video this week?
So it's a great question, and we covered a lot of the rare earth side last week because they actually upped their output. They've essentially saw the error with that when they tried to limit rare earth exports back in 2010, and just what that what that looked like, and we learned from that, and we've been doing things to try to diversify, with trying to increase and invest in Australia and Canada specifically to help break that apart, and then we brought some mines back online specifically in California. But to your point on solar panels, that is a huge problem. So we have about 71% of solar panels in China. We have about 80 to 85% of anodes and cathodes, which is just a pivotal component to those EVs and batteries in general. So they not only just have the solar side, they also have the EV side. So there is going to be a lot of strife, and this is where we're. I don't know if if those have seen. Biden issued that 100-day review of all vital supply chains, with one of them being EVs, batteries. But then it also goes further. It's also medicine. It's large industrial practices, just to see how much exposure do we have with China. And I'm going to cut it short. It's a lot. And what are we going to focus on this week? It's going to be what is coming out ahead of the Congress, which kicks off on Thursday into Friday, because it's a communist regime. So let's be fair. They essentially tell you what they're going to do, then they go to debate it. But it's Congress as a rubber stamp. So we're getting a lot of new information that we know is going to be locked into law come next week. So right now there was actually a good piece that came out that I was pulling down and trying to summarize, and I'm just going to read just to give you an idea of something that's coming. So, Minister of Finance Liu Jiwei, China will face mounting fiscal difficulties in the near future, and this is his quote. This is something that I've been saying, but this is his quote. Soaring government debt and global trade frictions will all create huge uncertainties and severe challenges for China's fiscal stability. The fiscal difficulties are not only a short-term issue, but also will be a serious in the midterm and long-term component on fiscal sustainability. So these are things that we need to look at and consider of what are they going to do. And in short, they can't stimulate the way they did in 2016.
So let's pivot to oil. Obviously, you can catch up on all of this with China and the overall macroeconomy impact to the bonds with the Primary Vision videos that are coming out this week. Subscribe to that channel. As a plug for the Hot Take of the Day podcast coming out next Monday, we actually have the author of A Question of Power, Robert Bryce, who also has the Power Hungry podcast coming on. And we're going to cover all forms of energy in terms of the pros, the cons, the costs, and how it all supports the grid, because sometimes the nuance of it's nice to have wind and solar, but how exactly does that work in the grid? Robert Bryce has a wonderful handle on that. I'm very excited about that. But we're going to pivot because this is OPEC week. And it's OPEC week because it ties back to 361 days ago, where I wish I had just entered into a coma. It would have been so much better, because I would wake up, oil would be the same price, natural gas would be the same price, stocks would all be up. Even if you work in Colorado, you're at like 52-week highs, despite the fact the government's passed the most restrictive setback rules ever. Doesn't matter, the party is on. But we have India asking OPEC to increase. We have friction with Russia and Saudi Arabia. We have $60 oil plus. We have a lot of dynamics of supply, demand, and the reopened trade. What are you expecting to see out of OPEC, and what does that do for oil? We always ask this. Are we going to hit 65 first, or are we going to hit 55 first, and what do you expect?
So I think that there's going to be a pause here. And when you look at what Saudi Arabia has done, they've increased exports by about 500,000 barrels a day from January into February. And this is just showing that they're even though they've cut their production, they're still maintaining their exports. And I think we're starting to see some difficulty in the market. And this is where they are going to have a difficult time in this specific meeting, because you have the paper markets, which have really run up. You have the North Sea markets, which are fairly stable, but then when you start looking at the West African markets and some of the other Middle Eastern markets, there's a lot of pricing problems. And when we look at Nigeria had to trade below OSP to clear some of their cargoes. We have Urals and CPC blends trading at 10-month lows. We have Angola that issued their allotment to UNIPEC, and now UNIPEC actually has turned around and is reselling 6 cargoes, and we actually have a decline of exports coming from the U.S. So that's not really indicating a really strong physical market, which is where they sell into, but the paper markets would tell you something very different. So they're going to have to try to indicate that, look, we're going to increase a little bit. I'm expecting about a 500 to 750,000 barrel a day increase, which will be mostly Saudi Arabia erasing some of those voluntary cuts. But they're going to have to say, look, you have to calm down. Like, the paper markets are a little far. Physical market isn't saying that, and try to bring some of this back under control, because the spreads are just not there to support them increasing, even though you would assume just based on what the futures are saying.
How much did they listen to a country like India, which has more than 1 billion people, is coming out of their coronavirus experience, although it was nowhere near like elsewhere, despite the immense poverty and lack of testing, they seem to have emerged quite fine. What do they do to a country like India, who says, we really think you should open up the taps and drop prices to presumably 50 would be better for their economy?
Right. Now, there are ways that they can do that without increasing. They can just cut the official selling price. So they could say, look, we still think that there's a certain amount of flexibility in the market. We still think that the physical market is oversupplied. But so instead of increasing production, we're just going to cut OSPs, or official selling prices, into India. And the reason why India is starting to get concerned is because their gasoline or petrol prices in general are at all-time highs. Now, a lot of that is driven based on taxes, because up to 70% of the price of petrol in the country is on a tax basis. And that's provincial based. So it can be anywhere from 53% to 70%, depending on the province you're talking about. So the government could cut prices, but Modi just increased fiscal spending, increased the deficit. So to cut more receipts is going to be a problem. Now you could say, look, you're going to support the economy. You'll get this back on the flip side, but they also have an inflation fear. So there's a certain concern that if they were to cut receipts, then people would start pricing in more inflation. And when they go to raise money through bond offerings to close that deficit, they're going to have to pay more. So it would be better for India if this originated from China, from OPEC, because then that means that they'd be able to be supportive. And to be fair to OPEC, they should want to incentivize more purchasing, keeping the prices on a bit more of a protected side. So, but then when we turn to China, China has come out now. They're saying that there's over 100 days of oil coverage. The data just came out for this year so far on diesel and gasoline, and right now they're at highs for storage for 2021. So clearly, the market has this disconnect where India is getting a little bit better. There's some COVID cases increasing in some provinces, but in others it continues to the downtrend. So it's going to be a bifurcation as well in that area. But China is seeing a lot of problems, and I think that should be more of a concern, and maybe pivot some of the oil that should be going to China into the Indian markets.
So let's talk about Iran specifically. We saw a lot. We also saw an airstrike in Syria, but in particular with Iran, there's been some geopolitical instability in that region. There's been some pushback. There's been talk about the nuclear deal. What do you expect to come out of the Iran situation in the next month, let's say?
I think right now it's going to be a hold constant. There's not going to be a whole lot of movement. I think the Biden administration put out a feeler, try to figure out, okay, guys, like, where do we stand? Iran pushed back hard, which I don't think was something that wasn't considered as the most likely outcome. The issue now is going to be where does Iran go from here? And they're facing a lot of problems along the Pakistan border, where they're seeing a lot of uprisings, and a lot of these areas were already semi-autonomous. And as the regime faces trouble at home, and just think about, they've had sanctions placed on them since Trump left the nuclear deal. That has hurt the balance sheet. They've had pressure coming from Israel just striking at will across Syria. So what do? They try to project power to their proxies across the Shia crescent, which led them to issue another attack in Iraq, which they tried to launch a missile attack at an Israeli ship. So these things were essentially a warning of, look, we're still here and still strong. But what does Israel do? Israel turns around and bombs some key locations, and the U.S. turns around and bombs key locations to let them know that that's fine, we're here to talk, but if you strike, we will strike back, and we'll strike in a very precise manner to hurt you as much as possible on a logistical level, but avoiding attacking the Iranian people, because the people are more and more in line with our way of thinking and are anti-regime at this point. So we don't want to do anything to rally the cause against us, and instead try to say, hey guys, it's your regime. If they leave, then things can change very quickly.
Anything else you're looking at for this week that we can look forward to in the Primary Vision show? Is he going to talk about stimulus at all, the drop of the minimum wage? I know we've talked a lot about what that potential has if minimum wage goes up for the loss of jobs, etc. But anything else you're watching in the next week or so that you think will be impactful?
Some of the things that we're going to talk about is on the employment side, because when we look at jobs, we've been talking a lot about this wage compression, and now that Indeed.com just put out some great pieces looking at the forced part-time, where people who want to work full-time but are being pushed to saying, hey, I'd love to hire you full-time, but you're going to have to be part-time for just because we can't afford it. So when we're looking at this, we want to talk about wage compression, because people are not working full-time but instead part-time, which is a reduction in wages. But we continue to see prices going up, and that's because of inflation, that's because of supply chains, because we've gotten used to some cheap things. Like, we know technology to constantly get cheaper, but it's not anymore. We're starting to see those prices going up. Cotton prices are continuing to go up. So how much of that price is going to get passed on to the consumer, just as wages remain under significant pressure? So we want to do a deeper dive on wages and savings, because everybody likes to point to, hey, look, savings went up. It's like, okay, I agree with you, savings went up, but we have to understand what percentage of savings went, like who in America is benefiting from that. And about 20% of Americans are seeing an increase in savings, but 80% aren't. We're seeing a bigger drawdown from savings. So this stimulus that was just passed, that will, or should pass in the next few days, that will go directly to those individuals. But again, you're just closing the savings gap. You're not really getting to the heart of the problem, which is unemployment, getting people back to work, and seeing those wages naturally increase.
Well, a lot on tap this week with OPEC, with the stimulus, with Iran, with continued pressure from China. Tune into the videos to do a much deeper dive. And until next time, I am David Ramsden Wood with Mark Rossano. Be safe, be good, and have a great day.
Thanks.